Just in, flash estimates for Singapore property. If you see, Q3 private homes rose 3.4%. What about HDB? Slightly lower, 2.4% quarter on quarter. You know, this whole title, I thought hard about it. I don't have a crystal ball. I don't know when the property markets will go down. I don't know if it will still go up by how much. I don't know. But I can stand by it because I'm going to define it. Best time? I'm pretty sure somewhere in future I can pull up a better time to buy property. At least that's what I'm voting with my own money. And more importantly, if you're buying a residential property with ABSD at 17%, I think it's very hard to justify it's a good idea. It means if you're buying a second residential property under your name, for example $1 million, you have to pay $170,000 in terms of extra taxes. And that's to add on to the $24,600 of buyer's stamp duty already, which means you're almost $200,000 down. You can see a service charge, you can see it's whatever, but this definitely is not a good way to start an investment journey. Then what about the part, buy investment property? Now I thought about the title of, you must be deluded if you're upgrading now, but that also is not correct because people upgrade for lifestyle needs. I do understand that, I do respect that. And not just that, some people are buying a new first home at this market cycle, and I also understand there is a need to buy a roof over your head. So that's why I want to define it more accurately. You know, right now there are so many misleading property advertisements. You can make 6 to 7 figures, property gains. Ignore cooling measures. Cooling measures are not going to slow the investment property cycle. Today I'll be debunking all of them, and if you are keen to hear an alternative point of view, continue watching on. Hi guys, welcome back. Pardon for the harsh tone in the intro video, but let me first define how cooling measures actually work and what's their real objective. Cooling measures are really not designed to cause markets to come down. Let's define it. It's really designed to prevent property bubbles. I repeat again, it's not there to cause markets to come down. It's there to prevent property bubbles. Australian governments could have done a bit more. New Zealand governments could have done a bit more, etc, etc. But Singapore property has not reached a bubble state, at least in my opinion, because government has intervened necessarily. The first cooling measure actually started in year 2010, and property prices actually continued to go up because there was global liquidity as governments actually printed money post global financial crisis. They introduced a second one, a third one, a fourth one, until December 2013 where property prices finally came down. Then the cooling measures stopped, correct? But that's because prices have finally come down already. So the whole notion that property prices will continue to go up despite cooling measures is wrong. The cooling measures need time to take effect, and it will continuously layer on until the momentum tilts. It's a bit like Spider-Man trying to stop a train. It takes time, it takes effort to stop, but as you can guess, it will eventually stop. Now, even if cooling measures don't cause a crash, what it can do is to cause prices to not trend upwards, correct? Just stay flat. And think about this. If you have a property loan, you are losing money to interest costs already, which means you don't benefit if the trend stays flat for years. Interest cost now using a fixed rate is 3.5% per annum. And even if you rent out your flat, you may or may not be able to cover this interest cost. Second part, if you are buying property with your CPF OA, you should also be aware that there's opportunity cost of at least 2.5%. So if prices don't go up, you are naturally already losing. So speaking to here, what exactly causes property prices to come down? Before we get there, let me start by sharing with you a quote by John Keynes. Worldly wisdom teaches that it's better for reputation to fail conventionally than to succeed unconventionally. I'm mentioning something that's unpopular right now, and whether it turns out correct next week, next quarter, next year, I'm not too sure about the timing, but I'm actually putting my money where my mouth is as I present this point of view. So if you're curious about this, continue watching on, stay to the end, because I'll explain things in a while. Now let's start on the first point as to why if you buy a residential property for investment right now and you think that's the best timing, it is likely not correct. The first point is that volume of transactions in property is slowing. Cooling measures, just now we mentioned about it, is there to cut transactions. Government recently has targeted HDB flats because they are seeing that there is a lot of monies flowing from en bloc to buy big HDB flats, causing $1 million HDB flats to become a norm. What that in turn feeds is that a young couple that has passed a TOP is now selling their HDB at $1 million plus and buying a condo. There is a feedback loop that creates property prices to go up both in HDB and private properties. They're trying to cut that feedback loop and they're trying to drive down transactions. The new cooling measures reduce borrowing amounts. The new cooling measures will also require buyers to put more in terms of deposit, up previously from 15% to right now 20% for anyone buying a HDB flat. That validates a bit on why I've sold out earlier on PropNext. That video has aged out quite well, you can check it out. And PropNext has actually seen a decline in terms of the share price recently after the cooling measures were announced. If you look in terms of their books, they can share an insight as to the transaction rate. You see that second quarter 2022 shows a lower revenue as compared to the previous year. PropNext, of course, is the market leader in property transactions, and they are a bellwether as to the transaction speed that is being experienced in the property market. So property volume causes an effect on property prices to go up. If that cycle slows, expectations slow, and that can contribute to property prices trending downwards. With that, let's move on to the second factor, which is the cost of mortgage. Do you know how much interest rates have going up? If you don't know, there could be two factors. The first is that you are not holding on to any property loan. You don't have a property or you have a fully paid property. The second is that you have a fixed rate in terms of your property loan. That's why you're insulated from it. If you haven't seen the latest mortgage rates, DBS, UOB, OCBC have all announced a big hike to their fixed rate packages. In particular, UOB's 3-year rate is 3.85%. What about for floating rates? Right now, it's about 3.1% per annum. Slightly cheaper if you're signing on right now only. Why so? Fixed home loan rates are there as an insurance against floating, which naturally means they need to charge a higher amount than the current floating. That only makes sense because you're reducing risk for a future event. Right now, floating rates are already 3.1% if you're on SIBOR. From my sensing on the ground, there are many that are seeing their fixed rates expire quite soon because they've taken 1, 2, 3 years back, or they are going to take a house pretty soon. The house is going to TOP, and they are going to have to take a floating rate from a bank pretty soon. Projects that are going to TOP very soon include Jadescape, Avenue South, and Normanton Park, and all of these projects have more than 1,000 units in total. What this means is that more households will feel a crunch in their cash flows because previously as projected, the mortgage could be $3,000, but right now it's projected at $3,800. That extra $800 on the loan causes a shrinking in the monthly budgets. Now, if you have experienced something like that, also leave in the comment sections and do validate whether this point of view is correct or not. So if mortgage costs going up, it is absolutely likely that there'll be more willing sellers, which can be a contributing factor to property prices coming down. Speaking to here, this is my biggest motivating factor as to why I'm putting my HDB flat on the market. This is where I'm actually collecting rent right now. I've actually openly shared my journey on this channel before. And you know, the rent is good. And as you heard, rental income or rental rates are definitely climbing in the months moving ahead. So if I were to remarket it, I'm pretty sure that I can command an even higher rental monthly rate. But I've still decided to sell. And with that decision, I've actually engaged ohmyhome for it. This video is actually sponsored by ohmyhome, and I'm actually happy to recommend them to you because I've seen firsthand as to how they run operations. Firstly, commission rates. Market practice is 2%, but it's actually negotiable. For ohmyhome, it's actually a flat 1%, so you don't actually need to even negotiate on that. It's just 1%. Very simple, very clean. The appointment is actually run by an agent, and by the way, this is my agent, who's actually helping me right now to put it onto the market. But the marketing is actually done by a team rather than just an individual agent. So you can see from my listing, it's actually listed on the best platforms: Property Guru, SRX, and 99.co. And from my experience, this is a very big difference because if you want results, you need exposure. So if just as you're thinking of putting up your home for sale, check out my links below. You'll be matched with one of ohmyhome's outstanding agents for your area, and this was the process that I went through myself. They actually conduct an accurate financial calculation and run through a home valuation report for your property to help you determine the right price to sell at. And when everything is decided, you actually see their dedicated marketing team working on to get your property to the right audience. So again, check out my links below and get in touch with ohmyhome today. Let's move on to point number 3, which is recession risk. A latest article mentioned that there's 98.1% chance that there will be a global recession. This is actually research done by Ned Davis. The causal factors are high inflation, drastic rate hikes, and a war in Ukraine taking its toll. It's mentioned also in the article that 7 out of 10 economies surveyed consider that a global recession is at least somewhat likely. Now, economists always like to follow a reasonable bandwidth, so I think that part, take a pinch of salt, because many of them, if you surveyed 6 months ago, will also be saying that the risk is absolutely negligible. A recession can have an impact on property prices. Why? The first is that it causes an impact in terms of the job market. Big tech, which is the most generous of payers right now, are freezing their headcount. Government sector in Singapore, a lot of the bonus is tied to GDP. And if GDP is not doing well, bonuses are naturally going to be smaller. And last but not least, impacting all industries, is that the threat of losing a job would naturally cause someone to be less aggressive in bidding in the property market. That's why property prices tend to come down whenever there's a big recession. If you scrutinize what has happened in terms of 2008 global financial crisis, as well as 1997 Asian financial crisis, you kind of know what can impact on a near-term basis. And since you start with me to here, I have a further bonus point to add. Liquidity seems to be shrinking. Stock markets right now are dropping, which means people are seeing losses on their portfolio. This is a small contributor to the wealth effect. Of course, the biggest one in Singapore is still property prices. Not just that, there seems to be a momentum building towards parking monies into safe assets. Banks have seen queues in terms of their fixed deposits. And when fixed deposits at 2.7% can attract so much capital in already, wait till it gets to 4%. That is when depositors and possible home buyers are more than happy to park monies there instead of taking risk in the property markets. Hopefully some points have resonated with you, and as always, if you haven't smashed the like button already, do so. Smash on subscribe because I am selling my investment property right now, and if you're keen to hear developments of it, stay tuned, I'll be sharing them along the way. And with that, I'd like to introduce you to some of my previous videos. The first touches on recession, and the second one touches on property markets. If you haven't seen them, follow them also, because maybe they can give you further insights on what you need to be aware of. With that, I'll sign off from here. Take care as always. Goodbye.